Hey guys, Merry Christmas, Happy New Year's, Happy Holidays in general to everyone. So I've been using this downtime to kind of go through different various financial content, and I just wanted to pass along just some kind of random interesting financial topics such as velocity banking and what's this other one that I'm infinite banking. So I just wanted to kind of share with you what that's all about and if and how it might apply to you, and to see if there's any stock market alternative to these type of ideas. So like the first one, so I was going through something called velocity banking. So I just want to say thank you to one of my friends that brought this idea up to me. I wasn't exactly sure what it was, and I did some digging on this. And so basically, velocity banking is you're trying to take advantage of a lower interest rate to pay off a higher interest rate. And in some cases, some people are really creative with this. They use things like those credit card, like those transfer checks, to pay off parts of like their mortgage. I'm not sure if you could do this with other big debts such as like student loans, but I guess like the idea is the same. You want to use something that costs you like a low amount of interest to pay off like something that's like a high amount of interest. So one idea is to either use a credit card transfer check and then use a chunk of that to pay down your mortgage payments, so that every time you chip away at your mortgage principal, there's less interest that you have to pay overall. Because if you go through like those, if you do like a work out the math on a spreadsheet, like over 30 years, even like if you have a relatively low interest rate, like at 3%, it still adds up, and it like the amount of interest that you pay could almost be as much as like the actual the principal in the house, depending on how high the interest rate is. It's pretty ridiculous. So that's why like it's actually pretty smart that whoever came up with this idea to pay down your mortgage balance faster. I think it could be worth it. You still have to work out the math though, to see if it's actually worth it or not. Because I've also seen some other people, they also recommend putting try to pay off your monthly mortgage on like a credit card through a service called Plastic. It's PLASTIQ. And I mean, I just did some basic math, but sometimes it might not be worth it. Even if you do get like credit card points or rewards, it's like, I mean, you still have to pay whatever interest, if any, on your credit card. Whoops, sorry about that. It looks like I might have gotten cut off in the middle of a sentence. The battery died. Sorry about that. But anyway, like basically for velocity banking, you have to be careful of how you go about it, to see if the additional fees are worth it for if you're using a credit card to pay off part of your mortgage debt. I mean, you have to. I mean, since your mortgage setups on a monthly basis, and you have to pay it off anyway, if you pay an additional 3%, whatever 3% or whatever fees that Plastic may charge on your credit card, you just have to see if it's worth it to you. Even you might pick up some additional rewards on your credit card, but I wouldn't like go out of my way to use it to pay down your mortgage. Otherwise, like if if it costs you more in interest than the actual like mortgage interest itself, it's probably not worth it. It might be worth it in the beginning of the mortgage principal pay down. So you have to just do some math, like get one of those like a mortgage pay down, like a spreadsheet or do it yourself. See, compare like the overall like interest that you pay on the mortgage versus like the fee that you pay on like the credit card to see whether it's worth it or not to you. I mean, I leave it up to you to see if it's worth it. But your individual circumstance will vary, obviously. And then as far as a like a stock market way to play it, basically you're trying to. It's almost like an interest rate arbitrage. So what you could probably do, you could look for something called mortgage REITs. You can look them up. Like right now, most of them have gotten beat up. Like some still haven't recovered from like the March 2000 lows. So you could probably like look around to see if there's anything that catches your eye. Most of them are pretty cheap because they've been pretty beat up. And then another thing you could look for is maybe like a floating rate fund. Like I found one that I'm already invested in this already. It's called JRO. So they are a closed-end fund that that tries to take advantage of floating rate notes. So it's sort of like bonds where like the interest rate fluctuates up and down with like the interest rate environment. So that could be like something you can look further into. It's not financial advice. It's something that I've been kind of that I already had in my personal portfolio. So it's not like a recommendation. Again, I always tell people don't just blindly copy what I or any other any YouTuber or anyone like the internet in general. Don't just blindly copy them. See if it makes sense for you first, and then if it just happens to make sense, then go for it. And then the next thing is I think is a little bit more interesting for me. It was like this something called infinite banking. So basically you put some money into like a cash value life insurance policy, and these policies, they have like this feature where it actually pays you dividends. These aren't like the same type of dividends that you get from like a company, because they're backed by the actual I guess like the insurance company, based on like the amount of premiums that they bring in. So it could be life or maybe some other type of insurance or financial product. I don't want to get too deep. I mean, there's plenty of other YouTubers that have covered this space, but I want to see if there's any like a stock market way to kind of do something similar. So basically, the interesting part is, at some point, like you put enough into the policy that that when you first start getting dividends, that's when it starts to get interesting, because you can actually borrow against this life insurance product. And the interesting thing is, you're actually like you're kind of like borrowing from yourself in like the future. So let's say like you build it up to say like maybe 50 to 100,000, and you can actually borrow against it to maybe do something else. So like maybe you want to put like a down payment on like a small investment property or something, and then once you pay it off, then you can take that money and put it back into your life insurance policy. And the interesting thing is like the dividends that you or compounding, it's compounding on that full amount, like almost as if you didn't borrow against it. So it's actually very interesting. I think the only con with this is maybe like you sort of have to put like money aside, and you have to put it like it's either upfront. You have to like build it up like after maybe like 6 or 7 years. So like if you're relatively young and you started early, or you have maybe like a like a rich uncle or something, and they're willing to, or a rich family member that they can help you like set this up for you, and then you can use it to kind of borrow against, and then like use it to pay down like other like big big debts like student loans or like a mortgage or something. So it comes in pretty handy. Or maybe you can use it to kind of finance your own real estate projects, because those seems to be like the major use cases. So it's pretty interesting. I'm looking into this myself, or maybe it might come in handy for myself one day. Like if I do, if I have enough to maybe have like a kind of like some rental properties in the future. But in terms of finding a stock market alternative, I don't think there's a direct stock market like alternative, because like instead of setting up like an infinite like banking model, is really more of like an infinite insurance model. So for example, one of like my favorite strategies is the Wheel of Fortune, because you actually get money up front, and then you have like kind of like the potential liability later. Like say for example, if you sell a cash secured put, you're actually on the hook to buy a stock at a certain price sometime in the future, but you get like some money up front. So which is a little almost like the reverse of like the infinite banking, where you have to put money in first and then later then you can like borrow against it. So I actually prefer the infinite insurance model rather than the infinite banking, and that really goes back to like the cost of capital, whether you have like a positive carry or like a negative carry. So in case you're not familiar with those terms, basically if you have to pay money like up front to get like a benefit later, that's more of like a negative carry, because you actually have to have some money up front to put in. So that's like a negative carry. But for I guess like a short the way like the Wheel of Fortune works, you get like a positive carry where you get paid up front. You may or may not get assigned, so you still have like a potential liability, but you already have like some cash up front. And then if you do this enough time, you can actually have like a whole bunch of cash, you're ready to deploy it, but like the obligation might not even come to you if you sell like a high enough volatility, or you sell it like so far out of the money that like the probability of you getting assigned is very low. It's not zero, but it's very low. So you kind of have to kind of manage your money based on that. And that's how a lot of successful insurance companies, like that's why they have like so much money to work with, because like if you have like really good statistical models, you can you already have enough money to set aside to pay out any potential claims. And that's similar to what we do with the Wheel of Fortune. But if you wanted to maybe get something approximate to like the infinite banking model, where you're paying money out, what you could probably do is you could buy a leap on like one of the like a dividend paying king, maybe like 5 to 10% out of the money. It might not have like immediate value, and actually you actually still have negative carry, because you paid money up front and you lose a little bit of money each month. But if the company, if you have if you pick the right company where it compounds like its returns over time, and if you buy out enough and you give yourself enough time for that leap to go in the money, then what you could do, once you feel confident that like your the leap might expire in the money, then you can sell like covered calls against it. So basically then it becomes almost like the dragon diagonal strategies that I've talked about before. So that could be one way to kind of approximate what you could do with the infinite banking strategy. Again, you could probably just go on YouTube and or Google and do a bunch of searches on velocity banking and infinite banking, and I hope that some of these topics you could find interesting for your own like personal financial management. If you like this type of video, please consider liking and subscribing, and let me know if you want me to cover any other financial topics, and to see if there's ways to do something similar within like a normal like brokerage account, or like within the stock market. I'll be happy to help you guys. So if nothing else, I just want to say thank you for watching, and have a great holiday season. Please stay safe now. Bye.